Hans Redeker, head of FX strategy at Morgan Stanley, joins us now. And Hans, you actually see the euro continuing to weaken, and in fact, to some extent, actually driven by ECB policy. That would be in their interest to see the euro continue to weaken.
That is absolutely right. So our targets for the year end is euro dollar 1.19, and then for the first quarter next year 1.15. So with that, we presented ourselves as one of the more bearish houses concerning the euro. Now the question, can we use the euro as a policy tool, and what are the pros and cons of doing so? We have to recognize that in Europe the credit multiplier is not working in large parts of Euroland. And when the credit multiplier is not working, you think, what is the alternative you can use? How can you revive the economy? You need to export the credit multiplier, you have to export or import revenues. And that means that the euro comes in here as a policy tool. Now, when you look what happened in the past as they were providing long-term liquidity, they did not change the price for liquidity, and therefore the euro was relatively static for a few months.
In terms of not changing interest rates?
Absolutely. So if the ECB now goes ahead and changes the price of liquidity, it is going to have a profound impact on the euro, and it is going to make the euro declining. What is currently happening is we are seeing the euro moving lower because of the Greek situation. That has a lot to do with uncertainty if Europe is going to lose a very important asset. If Greece is going to exit, if that would happen, then you would have the irrevocability of Europe no longer in place. And I believe that is a very big asset. You have to consider what it means if you take that out.
Because then Italy, Spain, Portugal, Ireland all start to question whether they too can exit the euro as well.
That is what the market would question, and but not only the market. Now assume you take Greece out and assume that, let's say, in 2 years' time Greece looks great.
Yeah. It's managed to devalue, it's managed to get itself back to growth. We would not
recommend that, but I mean there's a possibility that that would happen, right? And then all of a sudden then somebody in Portugal would say, look at these guys, you know, they had been successful with this devaluation strategy, so we are still suffering. And that is going to be very, very difficult. And when you get that into people's minds, then it is going to be very difficult to have sufficient firewalls. So it is not a financial issue. It is an issue which goes beyond that. It is an issue which goes into people's minds. And we are here in Europe in a democracy. And that actually means, yes, you can deal with pro-European governments, but one day these pro-European governments are going to be made accountable for their action. And in the case of Greece, people were not satisfied with that. In the case of France, people were not satisfied what they did see.
So now we're seeing this anti-austerity drive.
You see that now it goes into a pro-growth drive. Yeah? It is not yet an anti-austerity drive, but it certainly goes into that direction.
Yeah. Hans, you say $1.19 for the euro by the end of the year, potentially going down to $1.15. Is that factoring in an ECB interest rate cut? When do you see that coming? And also, is it factoring in Greece exiting the euro? Could it be even worse if Greece did leave?
Yeah, our economic research team indeed does suggest that the European Central Bank is going to cut rates in July, and that is going to have an impact on the interest rate differential. And what our research actually showed over the past few months, we did see a divergence of the solvency risk in Europe, which was still very high, and the liquidity risk, which came down because of the tender. And what we are now seeing is that the liquidity risk comes back into force, right? And as that is happening, you see a lot of money market funds which went into Europe in the period of January, in February and March, as there was this confidence concerning the LTRO. These money market funds are no longer investing in Europe, and that means that the euro is going to come under selling pressure.
I see. And so where, therefore, if we're coming out of the euro because you see it weakening, is money therefore going to continue going into the dollar, into the yen, into the pound, into these so-called haven trades?
Yeah, sterling is a very interesting example because we use sterling as a leading indicator for upcoming stress. And the way to do that is you look at the one-year forwards and sterling. And what happened last year in June is that sterling diverted from the one-year forwards. And it indicated that there was a safe haven demand for sterling. And you had always to ask, when this divergence is taking place, what is behind it?
Yeah.
And guess what? We did see the same happening this year in March. So at a time where people were still talking about the success of the LTRO, sterling told us a message saying that risk-absorbing capital is leaving the Eurozone. It goes into the UK. And it gave us the right signal at the right time to become more bearish as we were trading at 134 in euro-dollar. So that needs to be continued to watch. Indeed, the US dollar is going to be the ultimate safe haven in this environment. And I guess what we are now seeing is a movement where a couple of months ago people were in alpha-seeking trades. We are going now into correlation trades, and correlation trades are dollar-supportive trades.
Hans Redeker, thank you very much. So it's going to still see money flowing into the dollar. Hans Redeker, Head of FX Strategy at Morgan Stanley. Wonderful to have you in on the show.